Now, looking at the capital gains tax, which is primarily the tax that is applicable only on the gains that are being made and realized during a particular year. Only when I have sold some asset, sold some investment, and by selling it, I have made a gain on the top of it, means the price at which I have sold is greater than the book value of that particular asset or investment. The difference is what I am calling as capital gain, and I am paying a capital gains tax on the top of it. Now again, just like the case of income tax, there are a few elements, there are a few assets in few companies that are completely free of capital gain tax. So we really need to understand which of those kinds of assets are exempted from capital gains tax and do the computation accordingly. But whatever we are whatever we talk about as a particular capital gain, that for which the charge is existing, we talk about that chargeable gain simply as whatever the selling price that we have made minus the purchase cost. And if we have used it over a certain period, the purchase cost is nothing but the book value of the asset. And here the selling price, I can always reduce it by the cost that I am incurring to sell it. Whereas the purchase cost, I can always increase it by the cost that is incurred to purchase it. And any kind of enhancement that I have done till date over the period which I have typically held. The difference between these is what is contributing to the capital gain, and on this capital gain a tax is expected to be paid. And in some cases over this capital gains tax, there could be a kind of an inflationary indexation allowance. A kind of indexation allowance is very much possible, which will remove the kind of inflationary element. I mean, I have made a gain just because of the inflation being 10%. So that inflationary element is removed, and the tax is levied on the top of it. And one more interesting principle with respect to capital gains tax is if I have made any kind of capital losses during the year, I can very well adjust it against the gains, and only on the net gain I am supposed to pay a capital gain tax. And just like the income tax, even there is some amount of allowance with respect to capital gains tax. Only in case your capital gain is greater than the allowance that is there corresponding to the capital gain, only that on that difference the capital gain tax is levied. And that much the difference kind of an amount is added to the actual income of the individual in case of individuals, or it is typically added to companies income, wherein from where they pay a corporation tax, because even the investment income and investment gains are a part of the corporation tax, and in case of individuals it is added to the income, and based on their marginal tax rate bracket they would be charged the capital gain tax, or they would be charged the income tax on that amount of capital gain which is included as a part of the income tax. So depending on the level of their taxable income, they are making the tax payments accordingly, right? And probably you are looking at a few other taxes that and in that either individuals or companies could be levied. There could be a stamp duty, especially with respect to those kind of documents where there are contracts, like a registration document for purchasing a house. There is a stamp duty that is applicable. With respect to the properties that I have got from my ancestors, there is an inheritance tax. For every property that I am owning on a regular basis, I have to pay a property tax. Or there could be a taxes specifically to some kind of expenditures, right? Any kind of expenditures that are incurred, there are taxes. One associated in case of like a general stuff like a sales tax, or there could be something for specific kind of items like customs or excise tax. Customs is more associated with the imported goods, and excise is more associated with the goods that are produced and sold within the country. For every item that is sold, there could be a sales tax, right? And again, within that sales tax, probably this is only on the end item, but a value added tax VAT is primarily at every stage of the value addition process. A tax is levied. So what we could typically see is different kinds of taxes could be levied by the government over the various individuals as well as companies, primarily for the purpose of raising revenues for implementing various welfare activities. But at the same time, they are very much known to provide some kind of double taxation relief, especially for a person who has got taxed on his income abroad. At least there is an arrangement with almost all the foreign countries in such a way that if a person had already paid the income tax and capital gain tax in that abroad country because he was there for some period of time, if he has paid a tax there, the double taxation relief says he need not pay a tax on that particular income when it comes back to its domestic country. So the local tax authorities, they allow the companies and the individuals which are having the overseas income and capital gains. Overseas income and capital gains, they can very well offset the tax that they have paid abroad for their corresponding to their liability. They can very well adjust it with the domestic tax that they really need to pay. But the only maximum offset is subjected to the amount of the maximum tax that they are supposed to pay locally. So even if they have paid more than that local tax liability abroad, there is not going to be any kind of refund for them. But if they have paid a smaller amount abroad, the balance has to be really paid in the domestic country. So this kind of mechanism is called as a double taxation relief. It is actually relieving the individual from being taxed twice, one in the foreign country and one in the domestic country. So a lot more exists on taxation, but at least this gives you a very brief overview of the different forms of taxation which could be levied on the individuals and the income by the government at various stages. Right?